All right, welcome to the deep dive. You guys have sent in a lot of sources lately on a really crucial issue, and that is the impact of tariffs, specifically how they affect small businesses when they're trying to get loans.
Yeah,
So, our mission today is to unpack all of this, figure out how it all works, and really understand how these seemingly abstract trade tools actually impact Main Street.
for sure. Yeah, the stuff you sent over is perfect for this. We can really dive in and trace the connections. We've got to go beyond just like what is a tariff and see how they affect everything, from day-to-day costs for a business to how risky they look to a lender.
Okay, so let's get into it. First off, for anyone who needs a reminder, what exactly is a tariff?
In the simplest terms, a tariff is a tax that a government puts on goods coming in from other countries. It's like a fee you pay at the border for imported products. And it's collected by the customs authorities as those goods enter the country. But the key takeaway is that it's specifically on imports. That's what makes it different from other taxes and why it's so relevant to businesses that rely on global supply chains or compete with foreign-made stuff. And for you listening, trying to understand the lending side, that tax on imports directly hits the costs for a lot of small businesses, and that instantly makes them riskier to a bank.
Gotcha. So it's not just a general sales tax or anything, it's a targeted tax on stuff coming from overseas.
Exactly.
Okay, so then why do governments even use tariffs? It seems a little old school?
Yeah, that's a good point. Tariffs might seem kind of old-fashioned, but they actually serve several purposes. Some are traditional and some are very much relevant today. One big one is to protect domestic industries. By making imported goods pricier, tariffs make products made at home more appealing to consumers, right? Historically, this was super important to help new industries grow without being crushed by competition from abroad. And one of the articles you sent over even suggests that some economists think certain small businesses benefit from this because it reduces competition. Do you think we should look at that side of it and how that might affect their chances of getting loans?
Oh, that's interesting. So tariffs could actually make some domestic small businesses more competitive, making them better loan candidates?
Yeah, exactly. Think about it. If there's less competition because of tariffs, a small business might see more demand for their product. That could boost their revenue and profitability, making them look much better to a lender. But of course, there's also the flip side, the downsides, which we'll get to. Historically, another major function of tariffs was to generate revenue for the government. Back in the day, they were a big source of income for many countries. But these days, in most developed economies, income tax and sale tax are the main sources of revenue. So while tariffs still contribute, their use now is more about trade strategy.
What do you mean strategic?
Well, governments can use tariffs as leverage in trade negotiations. Just the threat of imposing them, or actually putting them in place, can push other countries to change their trade practices or be more open to doing business. They can also be used to counteract what a country sees as unfair practices by other countries, like dumping. That's when a country floods another market with goods sold below cost to undercut competition, or when foreign governments give illegal subsidies to their industries. And of course, we can't forget about retaliatory tariffs, where countries basically respond with their own tariffs, and that can turn into a trade war with consequences for everyone. And, for you as a listener trying to understand lending, that suddenness is a big deal. A small business might get hit with tariffs out of the blue, throwing their finances into chaos and making lenders super hesitant.
It seems like walking a tightrope, and there's always the chance of things backfiring.
Yeah, for sure. And finally, we've got national security. In certain key industries, a government might use tariffs to ensure they have domestic production of vital goods. That way, they're not reliant on other countries in case of an emergency or crisis.
Okay, so we see the different reasons for tariffs, but how are they actually applied? Are there, different types of tariffs that a small business owner might come across?
Yeah, there are a few main types. The most common one is called an ad valorem tariff, and it's basically a percentage of the value of the imported goods. See, with ad valorem, it's percentage-based. That means if the price of the stuff a business is importing goes up for any reason, the tariff goes up too. So for a small manufacturer taking out a loan to buy imported parts, that makes things riskier. Then there are specific tariffs. Those are fixed amounts per unit, like $2 per shirt or $300 per computer. It doesn't matter how much the whole thing costs. It's a flat fee per item. And finally, there are tariff rate quotas. So a low tariff rate applies up to a certain amount of imports, but if you go over that, boom, a much higher rate kicks in.
Yikes. That quota system, that has to create so much uncertainty for businesses that depend on importing a certain amount of goods.
You got it. And generally, all these tariffs work according to a standard system for classifying goods. In the U.S., we have the Harmonized Tariff Schedule, or HTS-US. It's this huge catalog that categorizes practically every type of import and tells you the tariff rate for each one. And guess what? It's the importer's job to classify their goods correctly. It's this big, complicated rule book for imports. And you got to understand, dealing with that can be a major hassle and cost for small businesses, especially if they don't have someone who really knows the ins and outs of customs. Lenders definitely look at that.
Wow, so it's like deciphering a legal document just to get your stuff across the border.
Sometimes it feels that way. And then there's the customs authorities. They're the ones in the importing country who actually collect the tariffs, inspect the goods, and make sure everything's assessed correctly at the port of entry. Sometimes importers even have to do self-classification where they figure it out themselves. So, yeah, there's a whole system behind how tariffs are applied and collected.
All right, so we've got a pretty good grasp of what tariffs are and how they work. Now let's get to the heart of it. How do these tariffs directly impact a small business, their bottom line, and their ability to keep the lights on?
Well, the most immediate impact is they make imported goods and raw materials more expensive. Remember, a tariff is a tax. So if a business imports parts for manufacturing, or raw materials to make something, or finished goods to resell, those items all cost more because of the tariff. And that directly eats into their profits. We're talking all sorts of sectors here: manufacturing, construction, tech companies, even service businesses. Like, imagine a pool installation company. They might need special parts from overseas. Now think about that local shop owner, What happens when the stuff they need suddenly costs a lot more? It directly impacts their ability to pay back loans and invest in their business.
It's a straight-up increase in their expenses, no way around it. And I'm sure it causes a lot of problems up and down their supply chain, right?
Oh, absolutely. Tariffs can really mess with established global supply chains. If the price of a particular imported good goes way up because of a tariff, that part of the chain might just become too expensive. Businesses are then left scrambling to find other suppliers, which takes time and money. In some cases, they might even have to completely change how they make their products. On top of that, new tariffs often mean more customs procedures, more paperwork, more inspections, and that means delays in getting their goods. For small businesses, this is a big deal. They don't have the same resources as big corporations, so dealing with all this and absorbing the costs is a huge obstacle. Setting up new supplier relationships or changing your whole manufacturing process, that's not something you can do overnight, and it's not cheap.
Yeah, and with all this uncertainty around tariffs, it must be a nightmare for small businesses to plan ahead and manage their inventory. How do you even know how much to order when the rules might change at any moment?
You nailed it. The unpredictability of tariff policies makes inventory management a huge headache. If rates keep changing or if there's talk of new tariffs, it's really hard to know what your costs will be and how much stock to keep on hand. Some businesses feel like they need to have extra inventory just in case, as a buffer against disruptions or price hikes, but that means tying up cash in storage and insurance costs, and there's always the risk that the goods will become obsolete before they can even sell them.
So it's a chain reaction of bad news. Higher costs, messed up supply chains, and inventory problems. That's got to be a huge hit to their profitability.
It really is. Think about it. Small businesses usually operate on thinner margins than big companies, so any cost increase hits them harder. When tariffs drive up their expenses, they might not be able to pass those costs on to consumers without losing sales. They often just don't have the size or bargaining power to eat those costs like a big corporation might. So their profits take a direct hit.
And less profit, that quickly snowballs into bigger financial problems, doesn't it?
Yeah, it really does. Lower profits lead to cash flow issues. If they raise prices because of tariffs, people might buy less, which hurts their revenue even more. Plus, tariffs often have to be paid up front when the goods arrive. That puts a strain on their working capital right away. And for businesses that don't have a lot of access to financing, that upfront cost can be crippling. They may struggle to cover basic expenses or invest in growth. And if tariffs cause delays, well, that just makes the cash flow problem even worse because it delays their ability to make money.
It's like a perfect storm, everything working against them. Lower profits, less cash on hand, and less ability to grow.
It's a tough spot to be in. With less profit and tight cash flow, it becomes almost impossible to invest in things they need to stay competitive. New equipment, new products, hiring more people, expanding to new markets. And the uncertainty around future tariffs makes them hesitant to commit to any long-term plans. Plus, they might find themselves at a disadvantage compared to bigger companies that can handle the tariff cost better, or foreign competitors who don't have to deal with the same tariffs. They could lose market share.
So it's not just hurting them now, it's affecting their ability to compete and thrive in the future. And I bet all this makes lenders nervous when these businesses come looking for loans.
Oh, definitely. Lenders look at a borrower's ability to repay a loan, and that comes down to their financial health. The negative impacts of tariffs, lower profits, cash flow problems, higher costs, all of that makes small businesses look riskier to lenders. And this is especially true for businesses heavily reliant on imports or those facing tougher competition because of tariffs.
So in a lender's mind, the risk of giving them a loan goes way up. What does that actually look like when a small business needs financing? What changes for them?
Well, lenders often tighten up their standards. They might require higher credit scores from the business owners, want more collateral to back up the loan, and really scrutinize their financial records and forecasts. They might also be less willing to give out loans with high loan-to-value ratios or shorten the repayment periods. All of that is to protect the lender from the perceived higher risk of the business failing to repay.
Which logically means more loan applications are getting rejected, right?
Exactly. With higher perceived risk and tougher standards, many small business loan applications, especially from those hit by tariffs, are getting turned down. These could be perfectly good businesses that would have gotten the loan if things were more stable and predictable. This lack of access to credit can be a real roadblock. It prevents them from managing their higher costs, investing in equipment or working capital, or even just keeping the doors open.
And even if they do get approved for a loan, the terms probably aren't as good, right?
Right. Because of that higher risk, lenders might charge higher interest rates or offer less flexible terms. Higher interest rates, of course, make the loan more expensive for the small business, adding to their burden. And inflexible terms, like shorter repayment periods, can make things really tough, especially if they're already struggling with cash flow because of the tariffs. So even getting a loan can become harder and more costly in this kind of environment.
It's like they're getting squeezed from all sides because of these tariffs. And we haven't even talked about how these higher costs for businesses end up hitting the consumers who buy their products.
Yeah, that's the next domino to fall. When businesses have to deal with higher costs due to tariffs, they often have to pass at least some of that cost on to consumers. That means higher prices for goods and services. And this can affect a huge range of products that rely on imported parts or materials at any point in the process.
So everyday stuff from appliances to groceries could get more expensive just because of tariffs somewhere along the line.
Exactly. And when prices go up, people start looking for cheaper options, they cut back on spending, or they just hold off on buying things they don't absolutely need. We actually saw a report recently from PYM NTS Intelligence that showed a lot of consumers are worried about how tariffs will affect their wallets, which means they'll probably change how they spend based on price increases.
And that drop in consumer demand comes right back to hurt small businesses even more.
For sure, less demand equals less sales and less revenue for small businesses. That makes it even harder to cover expenses, pay off debts, and repay any loans they might have. So the cycle continues, and the risk for lenders just keeps going up. And in some cases, if tariffs make imports way too expensive, businesses might have to stop selling those products altogether, which is a huge blow for niche businesses or those that offer a variety of imported goods.
Sounds like a recipe for disaster. And it seems like all this uncertainty around tariffs just makes everything worse.
Absolutely. The unpredictability of tariffs makes the whole economic environment volatile. Businesses, especially small ones without a lot of resources for planning, have a hard time looking ahead when they don't know what their import costs will be next month, let alone next year. This uncertainty makes banks and other lenders more cautious too. They tighten up lending not just for businesses directly involved in trade, but for all small businesses. There was a recent study, the 2025 Certainty Project, that found that a huge majority of CFOs think tariffs are going to make things even more uncertain and make financial planning a nightmare.
So it's not just the direct costs of the tariffs, it's the whole instability they create that's hurting small businesses and their ability to get loans.
You got it. Small businesses can't make accurate budgets, predict sales, or make smart decisions when they don't know what's going to happen with tariffs. It makes it harder for them to adapt, and it makes them look riskier to lenders.
Okay, so given all these problems tariffs cause for small businesses and their access to loans, what can be done to help? Are there any programs or policies that can support them through this?
Well, there are government programs that aim to help small businesses get loans in general. Things like SBA loans, the 7A 504, and microloan programs. These basically work by partnering with lenders and sharing some of the risk, making it easier for small businesses to get funding for different purposes. There are also USDA rural development programs for businesses in rural areas, Treasury Department programs like the Small Business Lending Fund, and even programs at the state level that offer things like loan guarantees.
But you mentioned earlier that these programs aren't specifically designed for the problems caused by tariffs, are they?
You're right. Those programs are helpful, but they're more general. We probably need more targeted solutions for businesses specifically struggling with tariffs. Governments could add up special loan programs with better terms for businesses clearly affected by tariffs. They could also think about temporary relief, like exemptions from tariffs, or subsidies for businesses in the hardest-hit industries. Helping businesses export more could also be a good idea, especially for those facing retaliatory tariffs. That could help them find new markets overseas. And simplifying customs procedures and providing better guidance on how to classify goods for tariffs could really reduce the burden and prevent costly mistakes.
Makes sense. And what about the small businesses themselves? What can they do to deal with tariffs and make their businesses more resilient?
It's all about being proactive. That's how you survive and thrive in this environment. One thing they can do is diversify their supply chains. Actively looking for suppliers in other countries, especially those not subject to tariffs, reduces their dependence on specific goods that might be hit by tariffs. Another option is exploring domestic sources. That's not always possible, but it's worth looking into. They'd need to weigh the costs and quality, of course. They should also try to negotiate better deals with their current suppliers. And they might have to pass on some of those increased costs to their customers, but they need to do it carefully and be transparent. Getting more efficient internally and cutting costs in other areas can help offset the impact of tariffs too. And finally, communication is key. Staying in touch with customers about any price changes and emphasizing the value of their products can help maintain loyalty when times are tough.
So it's all about adapting their operations, finding alternatives, and managing their customer relationships. Sounds like a tough job.
It is. Small business owners are definitely facing a lot of pressure.
You mentioned real-world examples. Do we have any concrete cases from history or recent times that show how tariffs have actually played out, especially when it comes to small businesses and lending?
Yeah, we do. A classic example is the Smoot-Hawley Tariff Act from back in the 1930s. It's a cautionary tale about what can happen when you have widespread high tariffs. It triggered retaliation from other countries and led to a massive drop in international trade. It definitely made the Great Depression worse, and small businesses back then would have been hit hard. More recently, there was a report in 2025 from PYM-NTS Intelligence that highlighted a growing cash flow crisis among small and medium-sized businesses. They pointed to tariffs and reduced consumer spending as major factors. A lot of these businesses have very little cash on hand and limited access to funding, making them really vulnerable to economic shocks. We've also seen a lot of reports about higher material costs and supply chain problems for small manufacturers in the U.S. after the tariffs on steel and aluminum imports. And a study on the 2018 washing machine tariffs showed that while domestic production went up, so did prices for consumers. That suggests demand might have gone down, hurting small retailers selling those appliances.
So real-world consequences, both in the past and more recently.
Yeah, definitely.
What are economists saying about the future? What's the outlook for tariffs and their effects on small businesses and lending?
The general consensus from economic models is that widespread tariffs tend to push up prices for consumers across the board and could even slow down overall economic growth, especially if other countries retaliate with their own tariffs. And if the economy takes a hit, small businesses will feel it and lenders will become even more cautious. And the uncertainty around future tariff policies just adds to the difficulty of planning and investing.
So to recap our deep dive today, it seems like tariffs create this really complex chain reaction for small businesses. They push up costs, shrink profit margins, create financial instability, and ultimately make it much harder for them to get the loans they need to grow, innovate, or even just keep running. And as we've talked about, these aren't separate issues. They're all connected and make the whole economic environment tougher for small business owners.
That's a great summary. It really is a complex web of effects.
So here's a final thought for everyone listening. We've looked at the historical example of Smoot-Hawley and seen more recent data that's pretty worrying. How can small businesses proactively build more resilience into their models, not just for tariffs, but for all the unpredictable changes happening in the global economy? It seems like being adaptable and thinking strategically are more crucial than ever if they want to survive and succeed in the long run.
That's the million-dollar question for small business owners in today's world. A lot to think about.
And for anyone who wants to dig deeper into this topic, I'd encourage you to check out some of the government resources and mitigation strategies we've talked about. Thanks for joining us on this deep dive.